This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 6th. Some highlights from today's show. Trump puts an offer in volatility, ECB is now in focus, and German Bunds are alive again. Good day traders, and welcome to another Daily Market Rundown. Looking across the board, I think the key theme remains for this week, a lot of volatility, and that is going to remain over the course of the rest of this week. Of course, today should be a little bit of a quieter day where the markets just trade a bit more range bound as we head into, of course, the key risk event for the week, which is non-farm payrolls tomorrow. We'll talk a little bit about that tomorrow, so do make sure to join the stream then. Now let's get stuck in and talk a little bit about some of our themes. And I think the place to start is just to look across the bond space, because they are capturing the imagination of investors all around the world. We are seeing very, very aggressive steepeners put on in Europe. Why? Well, because they're talking about a lot of spending. And a lot of spending means back into the curve needs to rise to price in more growth, more inflation in the medium term. Also, what we're seeing is some expectations from particularly European central banks that perhaps interest rates are not going to be cut as far as expected because of this fiscal spending that's now coming down the pipeline. Now, the key takeaway, of course, yesterday was that the steepening happened primarily in European bond markets, but we also did see a little bit of steepener put on into that US market, and it has continued across the board this morning. Now, what this means and what you want to take away from it is that this is good news. Okay, in general, if we're going to see fiscal spending across the world, what we're going to in essence get is similar to what the US did in the last 2 years, where they just spent 6.5% debt to GDP. They were the star across the board. They outperformed growth. Rallied quite aggressively, and investors flocked and invested in the US stock market. Now what we're seeing is not just the US that continues with its fiscal spending plans, but also Europe. So in general, this is massively positive. There's absolutely nothing negative about this from a risk standpoint. And if anything, I think what this will start to shift, or what we should start to see once tensions calm with tariffs, is we should start to see the narrative flip around toward more growth oriented type trades, where we see DAX and S&P and all that start to move back up towards those record highs. Of course, in the near term, though, we have to deal with some of the concerns. And let's move, of course, to our first concern. And that's this tariff, this ongoing ping pong that's going on with the tariffs. Again, what Trump has done, and I think this just adds to this idea of what his actual underlying playbook is that he doesn't want to hurt the US economy. That's the key takeaway. Whilst he is putting tariffs on certain economies, he's doing it in a very targeted way where it does have an impact on the country that's ultimately exporting its product to the US, but it has very minimal, or it has less impact on the US economy. And I think that's the objective, what he's trying to achieve here. He's trying to sort of get a balance, a fine balance with these tariffs. And yes, the narrative and the sentiment right now is that this is going to create short-term pain. This is going to create a little bit of a pullback in growth expectations. But once we get a little bit more certainty around this, I think the bigger picture, the bigger sort of theme and the narrative that's going to develop over the course of this year is that, hey, every government's now spending. They're spending. We've got interest rates that are now a lot lower than where they were over the last 2 years. And the combination of relatively low interest rates with inflation moving back towards target, as well as fiscal spending, is going to prove to be very, very positive. Okay, now there's a lot of ifs and buts then. I think the key if, and this is the key sort of question mark, is this fiscal spending in Europe going to reignite inflation? Okay, that is the key, and that everyone wants answered right now. If it is going to ignite inflation, well then yes, we are going to have some challenge to the thesis of higher equity markets. But if we don't get a reignition of inflation, ultimately what we do get is economies that start to expand at a time when we desperately need it. Now, in terms of Trump, I think we want to also look at what the playbook was when in February, if you go back to February the 3rd, you cast your minds back. This is the first time he sort of told us about how he was going to put 25% tariffs on Mexico and Canada. And we can see the markets responded very, very aggressively. Okay, we had a sell-off, a gap lower, and effectively the markets very much panicked. He then came out the same afternoon on February the 3rd and said, look, if they solve the problem at the border with fentanyl, he will be willing to give them a little bit of reprieve. He'll give them a 1-month sort of test to see if they actually do come to the table and do what's expected. Okay, market staged a rally, and we had a very aggressive bid up to close that gap. The next day, okay, what happened was the market opened and drifted down all the way back down, okay? And that afternoon, what happened was the markets effectively staged a rally straight back up. Now, the reason I'm showing this to you is because I think these tariffs, or this sort of news that we got yesterday where, he's going to give a bit of reprieve to the auto sector, I think all that does is it squashes the VIX slightly. It calms nerves a little bit. It's not as bad as expected. Don't forget, whilst these headlines are coming in, fast and thick, if we go back to his election promises, he told us he was going to put tariffs on. Okay, what's ultimately happening is we're getting some form of tariffs, but they're not as bad as expected. Okay, it's very much just creating short-term volatility rather than big picture, medium-term problems from a growth standpoint. Okay, now what that means is ultimately what I expect to see today. If we go back and we look at that third, what we saw in the VIX back then was we started to get this little bit of a VIX squash, okay? And we can see how the VIX really normalized its way all the way back down towards lower levels. Now, I'm not suggesting we're going back down to 15. I don't think we will get back down to 15 anytime soon. I think we're going to need a number of things to happen for that to take place. But I do expect the vol will ultimately continue this series of lower highs and lower lows. So I'm expecting vol today just to get pushed back a little bit back down, perhaps even come and test that 20 mark. Okay, so not necessarily an environment in which you want to be taking aggressive risk, but definitely an environment in which shorts are going to be tested, and ultimately they are going to, we are going to see how much they want to hold on to those positions. Okay, so keep an eye on that. I think the general theme from what we got from tariffs back in Feb was as soon as Trump gives us a little bit of something positive, the markets tend to latch onto that. They tend to like that. Okay, now for today, one of our play of the days I think is very much the S&P 500, and I've got it very nicely in a channel for you, and you can see the market's just distributing. Okay, all week we found a low around that 57.50. We then staged a very aggressive reversal back up to 58.75. We then sold back off down to yesterday around that 57.50, and then we rallied all the way down to 50 or up to 58.60. And this morning, like I said to you, you can see how post that positive tariff news, we've just sold all the way down. But what I expect to happen today, perhaps the cash comes in, tests around that 57.60, or we just stage a rally back up towards that 58.60. Okay, contained trade is the theme for today. Buy low, sell high. That is the nature of today. I expect that VIX to remain very contained, and I think price is going to stay within the range of 57.60 up to 58.60. Okay, there's no real reason to go beyond that. If you look at that 58.50, I think there was quite a bit of positive gamma up there. And if you know what positive gamma is, it means effectively it acts as a little bit of resistance. Okay, so have a look at those zero date options. I suspect there's still quite a bit of positive gamma sitting around that 58.50, which means it's going to act as some resistance for us. Okay. To the downside, in terms of some of the gamma levels, just keep an eye on that 57.50. I suspect we get below there, we are going to see a little bit of negative gamma come into play. And so what that does mean is it could ignite a little bit of a sell-off. Okay. However, like I said, I'm not expecting to break down below that range, but I am aware of it. Okay. So that's one of our plays of the day. If we then turn our attention to our second theme, it's very much about what's going on in Europe in terms of the bond space. Yields absolutely have blown to the upside. This is the German Bund. What we can see is the 200-day moving average was sitting around that 250, that 235 level. You can see the 200 moving average has been flat for the last 6 months, and all of a sudden, out of nowhere, Germany says they're going to spend a lot of money, and the result is German bonds have woken up. Okay, they've rallied a good 38 basis points yesterday, and we're almost back at that sort of cycle highs, which is around that 3% mark. Now, I fully expect we're going to get to 3% in short order, perhaps at some point this week, if not next week. But then I think markets are going to back off a little bit, consolidate a little bit, just allow a little bit of time for yields to just start to absorb what has happened. Now, a very good playbook, I mentioned this yesterday, a very good playbook is to go look at ECB 2014, 2015. Why? Obviously, as traders, some of you weren't around back then, but what you should see is that just because Germany is now going to have a lot more issuance, doesn't mean the issuance is all coming down the line straight away. Okay, we also don't know how much is going to be spent on defense spending. So there are a lot of ifs and buts right now. Also, don't forget, we need the Greens on board. And we know that there is a little bit of risk in that they could have some demands in order to get the votes necessary to get this fiscal reform through. However, the key thing is that the play that you're ultimately looking for is, rather than just, sort of a straight line move like we can see over here, is a little bit more of a drift type move, okay, where yields ultimately drift in a specific trend. Okay, so if I go back to that market, what you can see is we've had the initial reaction. I think markets will then back off a little bit around that 3% yield, and then I think over time we're just slowly going to push up and to the right. But note the price action here. There's a lot of two-way trade here. Okay, now I remember trading this. It was absolutely disgusting. It was really difficult to trade because you think the market's trending, and it is trending, but the manner in which it's trending is very, very important to pay attention to. So keep an eye on that. Go have a look at perhaps that German Bund from 2014-15. And the reason this is such a good example is because in 2014, what happens, we started to see a very, very significant slowdown in economic growth in Europe. But in 2015, they began the process of QE. Okay, what does QE mean? Well, it means you've now got a natural buyer, a new buyer in the market. Okay, what the fiscal government has done in Germany with a fiscal change is there's a new seller in the market, or at least there's someone that's now got more to sell. Okay, so ultimately, it's a very, very good playbook and framework to look at, because if we go look at what happened in QE, this was the announcement. And then you can see that trend resumes, but notice how it's trending. Okay, a lot of two-way trade. Okay, plenty two-way trade, and every now and again we of course got an increase in the amount of QE, and we had new economic forecasts coming in. But ultimately there was a lot of two-way trade, but the trend very much, if you look at the 200 moving average, the trend was very much to the downside. Okay, go and have a look at that. I think if you're a new trader, ultimately you do want to go and see how that played out, because I suspect we're going to get something very similar in terms of what comes next for German Bunds. One final note on that is, don't forget, of course, that we have done quite a fast move in the near term. If you look at that chart, this is quite a significant repricing, and of course we do have the ECB today, so there is going to be quite a lot of chop and volatility around that ECB. Okay, let's now move on and turn our attention and talk about some of the ECB moves. I actually did have an ECB rundown here. Let's see where it is. One sec. Where is that ECB? Okay, just give me a sec. I'm just going to get that back up. There we go. So if we have a look at that, one sec, traders. Let me just get this discard. Let's try this again. Why is that not showing? Okay. Okay, there we go. So just an ECB rundown. Of course, we do have the ECB out today. Some of the key things to focus on, it's 100% expected they're going to cut interest rates today. They're going to move from 275 to 250. That's pretty much priced into the market. There's no expectation that changes. I think some of the key things to pay attention to, of course, when we get the statement released, is whether or not they drop this restrictive. Now, again, I think it's expected to some degree, it's priced to some degree that they are going to drop this. Why? Well, because if you're going to signal a pause, you're going to remove this. Okay, if you're getting closer to neutral, you're ultimately going to say that we still kind of have a tight policy, but we're not as restrictive as what we once were. Okay, so the moment they drop that, what they're in essence telling the market is that we're getting a little bit closer to neutral. Now, there is some expectation that it drops today. So if they don't drop it, of course, what you are going to see is a little bit of a dovish reaction in the bonds. They'll rally up, and then perhaps in the Q&A, I suspect Lagarde will come out and say something a little bit more on the hawkish side. Okay, so you should get reversal plays in the German bonds, euro, as well as, of course, the DAX. The other one to pay attention to, of course, is Lagarde's general stance, her guidance. Her thinking at the last meeting was very much that it's very clear in terms of what the direction for policy is. I suspect she's either going to repeat that, or she's going to get quizzed on it by one of the reporters saying, Madame Lagarde, is it still your view that direction of policy is clear? And I think her response, that's very, very important. I suspect, given with what's going on in the fiscal space, with Germany considering spending, as well as, of course, the ongoing meetings in Brussels today, I do expect that ultimately she could soften that stance and say, look, we're nearing neutral, and ultimately that does mean now we need to be a little bit more vigilant as to what's coming down the pipeline. Okay. However, what does all of this mean? Look, I think at face value, the ECB is not about to suddenly shift their policy. Why? The ECB is not focused on near term. Also, we do not even have have an agreement in Germany yet. Okay, I appreciate that the likelihood of this going through is very, very high in Germany, but we just do not know what the fiscal response is like. We do not know how much it is. We do not know when it's coming into play. We know so little right now. The ECB is not about to make short-term decisions. They're not in that game. Okay, so expect pretty much an ECB that stays balanced, stays on course with, we've got more rate cuts, we're not done yet. We do have somewhere between another 25 to 75 basis points of cuts before we get to neutral. Okay, the general thinking is that neutral is somewhere around 175 to 225 in Europe, and of course after today they'll be down towards 250. So somewhere between another 1 or 3 cuts is ultimately what market participants are thinking. Okay, so it's going to be very, very hard for the markets to assume that this is it for rate cuts. However, if they do signal that, okay, if Lagarde was to say, look, this could well be it for this cycle, yeah, it's fine. You are going to get very hawkish responses because they need to price out that last little bit of cutting. However, again, it's not expected. And what is expected is to toe the line, keep things as is. In terms of pricing, just one final thing, keep in mind the market's fully pricing another cut in June. That's the next time we will get economic forecasts, and then obviously one final cut towards the end of the year. Okay, so right now the market's very much expecting a pause at the next meeting, and I do suspect that's going to be the theme from today's ECB, which is we're getting closer to neutral, so it's pragmatic and it makes sense for us to just pause, get a little bit more data, but rate cuts is still the consensus baseline expectation. Okay, that's a wrap then for today. Apologies for the little bit of a mix-up in some of these slides. One final note, like I said to you, the key economic data is coming out tomorrow, and there's a range of expectations with that. There is a little bit of chatter on the initial job list today. It could be quite a wonky number with a lot of the layoffs that we're having in the government side of things. There is some talk that the number could come in very hot today. Now, it's not that necessary the market's going to stage some sort of a trend-like move off of that, but you could see a little bit more volatility around the 130 initial job list release. Okay, if there are any other questions, of course, do post them in the Discord channels. Otherwise, again, the nature of the markets right now, it's volatile, so just make sure you adjust, and then, of course, use that risk tool. That's what it's there for. Make sure you're adding those trades into the risk log. Make sure you're trading with risk. Any questions, do ask them. Otherwise, good luck out there. Manage that risk. Go make some money.